So what does disappointment in China's economy look like these days? When it comes to weak data, often it's this: a sudden, albeit short-lived plunge in the Aussie dollar. That's where we saw the biggest impact from today's China HSBC PMI reading, the private sector manufacturing survey that was expected to come in at 51.2 this month, a healthy expansion. Instead, it was just 50.2, barely above the break-even point. So what does this tell us? Well, breaking down the data, new export orders bound for foreign markets are bouncing back from a contraction last month. But after seasonal adjustments, HSBC says that this expansion is fractional. Domestic orders, which point to consumption within China, came in below expectations. A small targeted round of stimulus from the government has helped prop up demand, but factories continue to slash jobs, adding more pressure, an anti-corruption drive that may tighten cash controls on free-spending state-owned enterprises. China's authorities are also expected to press ahead in the coming months with reforms focused on qualitative rather than quantitative growth. Despite these headwinds, our poll of economists forecasts a slight expansion for China's GDP in the third quarter to 7.6%. That may give way to slower growth in Q4, though, according to Nomura's Zhang Zhiwei. He expects the economy to resume its downtrend as policy screws are tightened yet again. So it may yet prove to be a rather challenging year-end for the world's second largest economy, with the fallout perhaps extending well beyond just a blip in the Aussie dollar.